Hey guys, just to check, can you guys hear me? Okay, sorry, just give me a second because my screen is apparently not showing. Just give me a moment before, let me try to fix this, all right? Sorry guys, let me just try to fix this because the screen is, the app is not showing my screen. Sorry, let me try something. Right. Just hold on for a bit. Let me try to fix this. Hold on, guys. Let me fix this for a little bit. Okay, just to confirm, can you guys still see and hear me? Yeah, because just now we had an issue with the sharing of screen. All right, so yes, can I just confirm that you guys can hear me and see me as well as see my screen? Okay, great, great. And how about my screen? Is my screen clear? Okay. All right, so let's just begin. Sorry for the delay, guys. All right, so today we are going through the Wyckoff strategy. And this strategy, I would say, is a very complicated strategy. So just be patient and with me, and I'll explain it to you guys. All right, so I hope that by the end of this webinar, you guys will be able to understand the concept of Wyckoff and maybe even try it out on your own. All right. So as usual, this is the disclaimer. So everything in this video is educational in nature, and nothing should be construed as investment or trading advice. So please do your own due diligence before you guys trade. All right. Okay, so for the agenda for today, we'll be going through what is the Wyckoff method. Secondly, understanding the Wyckoff method. Third, improving on the Wyckoff method. Fourth, explanation of the different patterns in the Wyckoff concept. And lastly, using it in trading. All right. So introducing your host, I'm your host for today. My name is Woon Hong, and I'm an investment analyst at Everest Fortune Group, and I'll be going through with you guys today's webinar. Okay, so firstly, what is the Wyckoff method? The Wyckoff trading method is a popular trading strategy that actually focuses on identifying market trends and using that information to make informed trading decisions, right? So it's of course named after his very own creator, Richard Wyckoff, and this method is used based on the principles of supply and demand. So if you guys have a background knowledge of supply and demand, I believe that those of you that have in-depth knowledge will be able to understand Wyckoff better. All right, but don't worry for those that don't really have a strong basis of supply and demand. It's okay. You can of course learn supply and demand through videos on YouTube, and it only takes you maybe 10 minutes of your time, right, to actually understand proper supply and demand. Okay, and one of the key concepts in the Wyckoff trading method is understanding the different phases of market cycles. Okay, so who is this guy, right? He's considered one of the 5 titans of technical analysis, along with Dow, Gunn, Elliott, and Merrill. So he wrote and edited the magazine of Wall Street and also founded the Stock Market Institute School. So these are just some background information on who Richard Wyckoff is. All right, so understanding the Wyckoff method. So we have a 5-step approach to the market. Okay, so firstly, we have to determine the present position and probable future trend of the market. So for example, if let's say you're in a buy, right? So you can estimate, you can maybe predict the future in a sense that you can tell where the markets could end up at a certain level before you exit your position. All right, so you should also select stocks in harmony with the trend. So if the trend is right now a very bullish trend, so pick stocks that are rising in prices, right, instead of those that are like falling behind. Okay, so you select stocks with a cost that equals or exceeds your minimum objective, and also determine the stock's readiness to move. So Wyckoff actually focuses a lot on market cycle, and it works best on pairs that don't have much consolidation, because if you have so much consolidation, right, the market doesn't really, you can tell that the market doesn't really want to move that often, and you will not be able to actually enter buy or sell positions often, right? You have to wait for pretty long before the price is able to either have a very bullish momentum up or a bearish momentum down. Okay, and the last one will be time your commitment with a turn in the stock market index. So commitment is basically what it means is that you have to be patient and you have to commit to this strategy itself in order for you to be able to execute this Wyckoff method overall. Okay, so understanding the Wyckoff method. Right, so firstly, we have our accumulation area. So this accumulation area is where the sellers are actually exiting their positions, right? So because this is the oversold position, and then the buyers are slowly coming in, okay? And after that, we have the markup, right? This markup is the bullish movement upwards. So usually you see the very long bullish candles, right? That could be your markup. All right, then this also shows that demand is greater than supply, right? Okay, then followed by overbought areas, whereby remember, all the buyers have already bought all the way to this selling area, right? So they bought and bought and bought. So this is your overbought area, also known as your distribution area, where the sellers will start to come in, right? And this is your markdown. So after accumulation is your markup, after your markup is your distribution, and after your distribution is your markdown. And your supply here is greater than demand, right? That's why you see for supply is actually something like resistance, right? And as for demand is something like your support. Okay, so we have three very basic Wyckoff laws, and firstly, the law of supply and demand determines the price direction. Okay, and we also have the law of cause and effect. Cause and effect meaning buyers accumulating, what's the effect? Bullish run, right? And then for sellers accumulating, what's the effect? Bearish run. Okay, and the law of effort. So okay, so improving on the Wyckoff method. So what are the different phases of Wyckoff? Right, firstly, we have accumulation. Second, markup. Third, distribution. Fourth, markdown, right? So you can see here, you can see these areas right here, right? The one with the asterisk right here. So these labels, later on, I'll be going through with you guys what each of these labels actually means so that you can understand why price actually moves in a certain way. Okay, but don't worry, so this is just the basic four market phases of Wyckoff itself. And then you have the so within this, let's say accumulation, right, is the cost, and then the effect is markup, correct? So in the cost for accumulation, we have your four main labels, which are selling climax, right? So that is your very first label, right? Second will be spring. Third will be low volume field sell off, and fourth will be your test. So usually people will enter on the test, and then your stop loss below this low right here. Okay, then during markup, we have this thing called jump the creek. Means it's multiple, so push up, come back, pull back, right? Push up, pull back. So this is called jump the creek. And then over here, before the distribution, right, we have buying climax, right? That's where all the buyers are actually exiting their positions and sellers starting to come in, right? So in here, you'll probably see like, do you guys realize that maybe after a very strong bullish or bearish run, there will always be consolidation before another push either upwards or downwards, right? So because the markets are never always perfect, right? You cannot always have a very bullish run and then don't have correction, right? So you can see here for distribution, we have buying climax, right? Failed rally meaning that it failed to break this high right here. Then test, so you enter on the test, okay? And then you'll break this consolidation to go downwards. All right, so this markdown is called break the ice, meaning that it started to break out of the consolidation period and have a markdown. Okay. All right. So what is a accumulation phase. So accumulation is basically a market phase following a prolonged downtrend characterized by sideways or range-bound activity. Right? During this period, smart money traders and institutional players discreetly gather positions without causing significant upward price movements. So, they start to pour in their buy positions slowly, right? That's why we have consolidation. Okay, and this Wyckoff is usually used by smart money traders. Okay, all right, so this is an example of your accumulation phase. You can see right here, after a very strong downtrend, we have a accumulation phase. Okay, prices moving sideways after the downtrend, right? Also known as consolidation. All right, and then once price actually have this, I believe this is the spring, and then this is the test, right? Price ready after the accumulation phase. Okay, some people prefer to enter a small risk here, right? And some people will be more confident once price breaks out of this consolidation period. So it depends on whether you're a risk averse person or you're maybe a trader that likes to take lesser risk. So this, yeah, so it's quite subjective in a sense that you can choose to enter right here after it goes back into this consolidation box, and then we'll have the push upwards. Okay, next, what is a distribution phase? So distribution is the inverse of accumulation, means opposite, right? Occurring after a prolonged uptrend. In this phase, smart money traders and institutional players aim to sell off their positions in a sideways or range-bound market without causing substantial downward price shifts. Okay, so you can see right here, after a very strong uptrend, right, we have your distribution phase, which is consolidation. Up here, prices moved into sideways after the uptrend, and prices fell after the distribution phase. Right, so some people would tend to maybe enter after the breakout, right? I'm pretty sure some of you may have experienced this before. After a consolidation period, you prefer to trade the breakout, right? But some people are confident in their trade. Maybe they enter after the break of these lows right here, right? And their stops are they'll put it here. Okay. So next, what is a markup phase? So the markup phase represents another step within the Wyckoff trading cycle, coming after the accumulation phase. So during the markup phase, price movement transitions into a long-term uptrend. Okay, informed traders who recognize this phase typically seize the opportunity to participate in the upward trend by initiating bullish positions. So this is where all the buyers come in, right? People want to hop on the trend because, as you know, the trend is always your friend until it bends, right? So for amateur traders, right, you should always follow the trend until it changes. Okay, then next, the markup phase stands out as the most lucrative stage for owning the asset or stock, and it aligns well with various growth and value investing strategies, in a sense that if it's a very bullish uptrend, if you are able to follow the uptrend all the way, you'll be able to profit. So this is an example of a markup phase whereby you have your accumulation, right? So the breakout, people enter on the breakout, then you have your markup phase right here. Okay, then you can see this is called jump the creek, meaning that after the push upwards and then rally down, right? So this is your pullback. Okay, so you draw a demand zone right here, and then the push upwards is your jump the creek. Okay, some people would like to enter another position right here, or maybe a slightly smaller position. Okay, or you should enter during the reaccumulation, right? But I've never really seen people enter again on the reaccumulation, because this could sometimes, through what I've noticed, right, after the reaccumulation could be pretty short, and then after that it starts to consolidate already. So if you entered on the reaccumulation, you may not be able to profit that much, and instead maybe just hit break even for your, if you enter a trade right here. But you see, if you have these two positions running, one after the breakout and one at jump the creek area, right, so you'll be able to profit all the way maybe up to this area right here. Okay. All right, so what is a markdown phase? So the markdown phase is another step in the Wyckoff trading cycle, occurring after the distribution phase. So during the markdown phase, right, um, the price movement shifts into a long-term downtrend. So this is where all the sellers come in. So this is why informed traders who recognize this phase typically either close out their existing long positions or start opening bearish positions. Okay, the markdown phase can bring about significant market volatility, making short selling a potential lucrative strategy during this stage. And if you guys realize, right, sometimes if, let's say, I am not sure if you guys dabble in stocks, but if, let's say, stocks, right, we have a very strong push upwards, and then it starts to slow down, right? So do you guys realize that sometimes when you're selling instead of buying, you're selling, your sell positions always tend to um, move faster than your buying positions, right? Because when psychologically speaking, people usually, when once you're selling, right, people usually panic sell, and they will open more sell positions, right? And if you're buying, you may be afraid that the price may reverse against you. So that's why doing for my trades, my personal trades, I prefer to enter sell trades instead of opening buying positions, because for selling, right, selling positions, I usually open, I'm more confident for selling positions if I'm able to see that, okay, after your distribution phase and then I enter my sells, right, then I'll be able to hit my take profit faster than if I enter buys. Okay, so one example I would say is, let's say, gold, right? You can see gold right here. Let me just sidetrack for a little bit and show you gold. Right, we can see right here, this very, very strong move down here, right? You can see that this movement only took 25th, only took 1 week, right, to drop. How many pips is this? Almost 1,000 pips, right? Just to almost 1,000, actually it dropped 1,000 pips, right? From about 22nd, 25th, right? 25th all the way to 25th September all the way to 2nd October, which is about 1 week, I would say, right? Just to drop 1,000 pips, which is a lot. And you see right here, yeah, even though you see right here, this is your markup. Okay, and within here would have your consolidation period. Right, so somewhere here you can see there is Wyckoff during this period. Then after the breakout, right, this is your push upwards. Okay, so let me just go back to the slides. Okay, yep, so this is an example of your markdown phase, in a sense that, right, we have your distribution phase over here, which is your consolidation, and then we have your breakout, right? And then you can see right here, after price broke out, it became bearish, right? and then price start to respect these highs over here. Okay, so this is where you draw your supply zone right here. If price starts going back up, then it's time for you to exit your trade. Okay, but price actually rejected this supply zone very nicely. So this area is called break the ice. So push downwards, retest. So this retest upwards, you draw a supply zone. If supply hasn't broken this supply zone, if price hasn't broken this supply zone, this is your break the ice area. Then we have your push downwards again. This is your redistribution. Okay. All right, so explanation of the different patterns. So this is where it gets a little bit overwhelming because you have to know what each label mean. Okay, so Wyckoff patterns in an accumulation phase, right? So we have so this is the overall outlook. Okay, then we have your selling climax. We have your preliminary support. Okay, and then after that we have your automatic rally, and then your secondary test, right? And then comes your spring. So your spring will usually break these lows right here. Okay, then it will start to go back, and then your test, this will be your test somewhere here. Yeah, so it depends on how you look at it, but this will be your test somewhere here. Okay, so after it breaks the highs comes your sign of strength, your SOS. Okay, so this is your breakout area, and some people like to enter after the spring, which is your test. Some people like to enter after SOS. Okay, so preliminary support is a support level that forms after a significant fall in market prices. It is caused by big institutional players and smart money traders when they try to acquire bullish positions after a strong sell-off. So in this image, you can notice that after a sharp fall, right, the price action bounced back and moved sideways. So that's the example of preliminary support. Okay, so yeah, once a preliminary support is established, market will find it very hard to break that support level because of strong buying interest. Okay, so selling climax is another pattern in accumulation phase characterized by a sharp sell-off. So it takes place before the preliminary support, and it indicates that selling pressure has reached a stage in which panic selling by the public will be absorbed by these big institutional players. Okay, and selling climax often coincides with bad news or some negative news, as it is caused by the panic selling behavior of public investors. So the big players often use the selling climax to acquire positions at a lower price. Okay, so what is automatic rally, right? So automatic rally is an up move that forms after the selling climax and preliminary support, and the underlying buying interest cause the prices to rally upwards. Okay, but quickly prices will fall back after making a new high. The highest point of this rally will become the resistance of the accumulation range. So this is, let's say, your resistance. So you mark out this resistance over here. Right, so after an automatic rally, intense selling activity from the public decreases and bearish sentiment becomes weaker. Okay, then comes your secondary test. So the secondary test formation happens after a automatic rally and is caused by the long covering process of public investors, which brings back the price to the area of I would say either at the PS or slightly wicking out this PS right here. So often prices will bounce back after touching the PS, indicating the presence of buying interest. And ST is a reflection that market prices have found the bottom, and it is common to have multiple. Just remember, you need not only have one ST, but it's normal to actually have multiple ST, right? As the market will retest the PS to check the strength of buyers. Okay, so springs are also known as your fakeouts, right? And it's nothing but fakeouts that happens within the accumulation phase. So prices will fall below the PS, right? Only to reverse back above the trading range. So breakout, fake breakout, go back into the trading range within a oh, okay. So I've seen people do Wyckoff even on 1 minute or 30-second time frame, but I find it pointless, because if you do it on such low time frames, right, it's not very effective, because let's say, right, instead of spring, let's say spring, it just breaks or secondary test, right, it just breaks this PS and goes down further, right, or goes up above the automatic rally and just break out, right? So that will make your this whole concept invalid. So you have to redo it again. So I would say minimally, it's best if you can find it on the 15-minute time frame, right? So higher time frame is to find your bias, like your buys or sells, right? Look at the overall time frame to see whether price is reaching a certain key level, and then you look for Wyckoff in that key level, right? Okay, so I would say either lowest that you should go is 15-minute or 5 minutes, right? And then your 1 hour and 4 hour are your key levels. Okay, yeah. Okay, so let's see what else. Okay, and lastly, yeah, no worries. Okay, so lastly, for sign of strength, right, it takes place after the spring, indicating a bullish sentiment in the market. So basically, sign of strength is like I'll say a mini pullback or minor consolidation at the resistance level right here of the accumulation range. So let's say we have your whole accumulation range right here, right? Your SOS is after it will reach the highs of this range before breaking out. Okay, it's like just remember that for SOS is a mini consolidation before the push upwards. Okay, so it's just a confirmation that sellers have lost momentum and prices will continue to rise on the upside. Okay, so most of the time SOS looks like a breakout setup, which is often followed by a sharp rally on the outside, on the upside. Okay, so this is something that you guys have to understand. Okay, so you can see right here we have the recap of markup phase. So right here after the breakout, right, let's say you enter after the breakout, right, so your stops will put at the previous low. Okay, and then you can see right here, you can remember previously I said you can choose to enter again at maybe the jump the creek, right, or yeah, so that's the second entry. But usually for Wyckoff, people use Wyckoff, right, to actually get a crazy risk to reward ratios. Like I've seen some of my friends actually hitting 1:50 kind of risk to reward ratio, because they're able to refine it all the way to maybe the 3-minute or 5-minute time frame. And if let's say you're on Euro USD, right, the let's say after the breakout to your previous low is maybe maximum of 5 pips or 6 pips, right? And then if the markup is about I would say if the markup is about 100 pips, right, so you risk 5 pips to gain 100 pips, and what is that? It's about risk to 1:25, right? Yep. So as much pros that Wyckoff's strategy actually has, it also has its drawbacks, which I'll talk later on. Okay. Okay. So Wyckoff patterns in markup phase. So we have your upside breakout. So it occurs when significant market players complete their accumulation of positions in the accumulation phase, leading to increased demand. So this actually pushes price to break through the accumulation range resistance, signifying strong buying pressure and attracting long-term buyers, which actually drives prices higher. So we also have jump the creek, and jump the creek is a notable retest that follows the upside breakout. You can see right here, right? Broke through, right? Then we have a small little pullback, right? So remember what I said, this small little pullback, you have to make sure that price doesn't drop below the previous low. Okay. And uninformed traders may attempt to sell the asset without realizing the impending long-term markup phase. So this could cause a temporary price drop, but prices typically rebound and continue to rise, trapping uninformed sellers. Okay, and lastly, we have reaccumulation. And reaccumulation is a sideways trading range similar to the accumulation phase, but occurring within the long-term uptrend. So it definitely indicates that significant players are still buying assets, right, within the uptrend with strong support in this pattern, which is right here. Okay, so it's either could be a trendline support, right, ascending trendline support, or a strong demand key level right here. So after reaccumulation, prices generally continue their upward trajectory, okay, until it starts reaching a distribution phase and then the seller starts to come in. Okay, moving on to so for jump the creek, right, it should not break let's see. Okay, so let's say we use this example, right? So jump the creek should not break. Let's say you have your push upwards here. You pull back right here, right? And then you should see these bearish candles. Like, don't take these insignificant bearish candles. You should take the bearish candles that have strength in it, right? You see right here, this bearish candles is valid, this bearish candle is also valid. So long as price doesn't break either this low or this low right here, right, then it should be fine, because price will generally start to gain momentum and go to the upside. Okay, so yeah, so if price breaks these little bearish candles, right, it's not that significant, because it could just be a just your daily market things, right? Price can break this low and then start going back up again. So don't panic. So I'll say so long as, let's say, price doesn't break this area right here, right, where there is proper demand zones right here, then price will go up. Okay, but let's say you should only enter after you see this push right here. Okay, so you see after the price bounces from here, then you enter again, stops placed below this low right here. Okay, if you're on this green candle, right, I wouldn't suggest to enter again, since you already have one position here. I would suggest to wait for price to maybe go up a few times, and just to make things clear, right, which candlestick will react well with these kind of patterns, right? In general, bullish engulfing, all your engulfing candles, like your bullish and bearish engulfing candles, always work best with Wyckoff, right? So usually you'll see wicks here. Let's say you see this long wick right here, right? This indicates that price is not able to break this low, right? And then it start going upwards. So if let's say you're in a markup phase, right? You would like to see wicks pointing out right here at the bottom of the candle. If you are in a markdown phase, you would like to see wicks pointing at the top of the candle. Okay. Yeah, went through this. Okay, so moving on to Wyckoff patterns in distribution phase. So we have your preliminary resistance, which is known as your PR, and it forms after a significant rise in market prices, and it's caused by these big players, right, when they try to acquire bearish positions or liquidate bullish positions after a strong rally. Okay, once a PR is established, market will find it very hard to break the resistance level because of strong selling interest. All right, then we also have your buying climax. So it is one of the pattern in distribution phase characterized by a sharp rally. So sharp rally from bottom all the way here, and it takes place before the preliminary resistance, which is known as your PR. So it indicates that buying pressure has reached a stage in which aggressive buying behavior by the public will be offset by big players. So if you see right here, your buying climax, you see these very strong bullish candles turning into bearish candles or very tiny bodies, right? Long wicks, tiny bodies. So this shows that buyers are actually exiting their positions. Okay. So yeah, so buying climax often coincides with good news or some positive events, as it is caused by the aggressive buying behavior of public investors. So big players often use the buying climax to offset their positions at a higher price. Okay, then we have your automatic sell-off, right? For accumulation phase is automatic rally, but for this we have your automatic sell-off. Okay, so automatic rally is basically just automatic sell-off is basically just a down move that forms after the PR and BC, and the underlying selling interest causes price to fall lower, right? So push up here, you mark out after you have the price, after price dropped, right? Then you mark out this level of resistance. Okay, and then you can see right here, after an automatic sell-off, intense buying activity from the public decreases and bullish sentiment becomes weaker. Okay, then here comes your upthrust. Secondary test. So the secondary test formation happens after an automatic sell-off and is caused by the short covering process of public investors, which brings back the price back to the preliminary resistance. Okay, so for ST, right, price has to go back to the PR area, okay, indicating the presence of selling interest. Okay, and then what about upthrust? Upthrusts are nothing but your breakouts that happen during the distribution phase, and the prices will rise above the PR of the trading range only to reverse back below the trading range. Okay, so yes, and right here we have SOW, which is your signs of weakness, which is the breakout, right? So breakout of this, it broke the low of this automatic sell-off, and then you can enter your sells. Okay, so SOW can form like a normal pullback or minor consolidation at the support level of the distribution range. So right here, so it's a confirmation that buyers have lost momentum and prices will continue to fall on the downside. Okay, so most of the time SOW looks like a breakout setup, which is often followed by a strong sell-off to the downside. All right. Okay, so very simple recap of markdown phase. So this is an example of Richard Wyckoff's markdown phase. So remember, distribution phase, breakout, break the ice, redistribution. Okay, so Wyckoff patterns in markdown phase. Right, we have your downside breakout, and it occurs when significant players like smart money traders completely sell off their positions during the distribution phase, resulting in decreased demand for the asset or stock. So this leads to a price decline that breaks the support. So right here, price decline breaks the support of the distribution raise right here, reflecting strong selling pressure and attracting short sellers, ultimately causing prices to move lower. Okay, we also have break the ice, and it is a notable retest that follows the downside breakout. Okay, uninformed traders may attempt to buy the asset without actually realizing the impending long-term markdown phase. So this could lead to a temporary price increase, but prices typically fall back down, trapping those uninformed buyers. All right, and also for redistribution is a sideways trading range akin to the distribution phase, but occurring within the long-term downtrend or markdown. But it indicates that significant players are actively short selling the asset within the downtrend. Okay, and so after redistribution, prices typically continue to move lower until it reach a strong support level. So let me go through with you guys how do you use it in trading. Okay, so what to look out for accumulation, right? So I have two different entries for you guys. One entry is aggressive entry at the test, right? Remember, just now I mentioned that some people that are more risk averse would like to enter after the spring, which is your test. So you see right here, so after your selling climax, we have your PS, then your automatic rally. Okay, then you mark out this line right here, this highs right here. You have your secondary test, and then after that you have your secondary test B. Then what comes next will be your test. Okay, so right here, let me just, okay, yes. So sometimes, right, after let's say you're scared to enter this, you want to see sign of strength first, right? So once you see sign of strength, price broke through, came back down, right, to retest this area, and then blue pass. So sometimes you can enter after the retest, right, and then you hold your trade. Okay, so what to look out for distribution, right? We have this should be BC, not SC, right? Your buying climax. And then what comes next? Right, your preliminary resistance. So this is around here. Okay, then you have your automatic sell off, right? Then you have your secondary trust, your up trust, and then your test. So sometimes people, once price come down, come back here, then you enter. The stops placed above this up trust. And then we have lastly the signs of weakness. Okay, signs of weakness, breaking out of this consolidation period and then selling off. Okay. All right, so you can see right here, buying climax, right? You have your automatic rally, you're up. your up trust, right? So up trust, and then you have your UTAD. All right, then you have your test over here, right? And then you will enter right here. Okay. Then some people would like to have, I'll say, early entries, right? But more often than not, Wyckoff is for you to actually take trades that has high RR, and then because you're able to snipe, I would say snipe in a sense, yep, snipe the pairs itself. Okay. Yeah, so this is this yeah, so it's important. Oh, and just a tip for you guys. If you are interested, right? Try to mix. I would say if you are interested in Wyckoff, it definitely works, but it just takes some time to get used to it, to actually spot out all the different labels, and then you'll be like, oh, okay, this is my buying climax, this is my automatic rally, this is my up trust, this is my test, this is my spring, right? But what I can say is that Wyckoff is very complicated, and you can do a much simpler strategy. But what I can recommend is that you learn more about liquidity when you're trading Wyckoff, right? So you see on the highest time frame, right? We can see right here, price may actually come down and grab liquidity over here. So liquidity in layman's term is just where the money's at, right? So usually prices with long wicks, that is liquidity. All right, because sooner or later, price will be able to reach that level. Yeah. Okay. Let's see. Do you guys have any questions? Because I covered most of the parts for Wyckoff itself, and I was wondering if you guys have any questions. Would it be a good idea to use a Wyckoff? Oh, okay. Let me just address that. So I actually tried. I'm not sure if they actually do have it. Let me see. Mm, okay, from what I am seeing, I would say for what do you call it? For Wyckoff, right? Is you shouldn't be using indicators, right? Maybe session timings or volume. That's about it. Volume is maybe could probably help you, but I would say the indicators to use for Wyckoff is not good, and you'll not be able to practice properly when you're trading using the Wyckoff method, because you're too dependent on the indicators to find it for you, right? That you neglect your own um, trading styles. Okay. Any recommended reading or YouTube to learn from? Okay, so if you are talking about YouTube, right? So this is what I can show you guys. I've watched it quite a couple of times. Oops, oops. Yeah, so this guy, I would say GFX, or you can see here Wyckoff plus SMC. These two videos are pretty insightful, and you can gain knowledge from there. right? Because they are talking about a simpler method of approaching using Wyckoff to trade, right? But because I have to explain all this to you guys, it will definitely take more than an hour. So as I would suggest for you guys to actually read, uh, hear about Wyckoff from him himself. Okay, which time frame do I use to analyze using Wyckoff? Like I said previously, the time frame that you can use would be 5 minute to 15 minute. Okay, and then for the higher time frame, H1 and H4 will be your key levels, right, and your daily bias. So it's very important to know where the direction is at. Okay, so the direction that you need to look at will be, let's say, after this down move right here, right? Then price starts going up. So it's possible for price to come up to this level right here, and then you can look for sells again. Or price could come back to this level. But I think it should not be able to break all the way to take out this low, right? You know why? Because price was not able to break these lows right here. Okay. Yeah, so yeah. Oh, thank you, Desiree. Appreciate it. Yeah, let me see. Okay, are there, oh, how do I take profit? Okay, for Wyckoff, right? Usually for Wyckoff, I like to keep it, I like to, let's say we have Wyckoff here, somewhere here, okay? Where I would, let's say I entered, right? Because I entered, let's say here, this looks good. This is my SOS, okay? Yeah. Then after that, I'll be looking for buys. Okay, so my stops, let's say long position right here, stops placed below the lows, target, where will I think go? Yeah, I believe go all the way to this level right here. Okay, so it actually reached all the way up there, right? But sooner or later, price will come to this level to take liquidity, and then the gold will start to fall. So I'll suggest to be patient and then enter the sell state. Okay, so for take profit wise, right, I would say that you either target a specific key levels or key levels with Fibo retracement in there. Okay, that's how I would tackle this problem. Yeah. Okay, so yes, I hope you guys learned something. Yes, no worries. I hope you guys learned something new. Okay, let me just yeah, so that's about it. I guess I've covered almost all the stuff. Right. So thank you guys for tuning in to the Wyckoff. Let me see, let me see. Oh, oops. Oh, sadly, there's no poll for today, right? Not sure what's the error, right? There's so many errors, right? Okay, but thank you guys for tuning into this webinar. I hope you guys learned something new. And please, of course, do your own studying, okay? Right. Oh, and manage position size. For Wyckoff, I only risk 0.5% of my account each time because I'm not sure whether this specific thing is a consolidation only or like breakout. And then yes, so I would say I usually risk either 0.5 to 0.75 of my account. All right, so yes, thank you guys for tuning in to today's webinar. I hope you guys stay safe, trade safe. All right, and I'll probably see you in the next webinar when I have the opportunity to. Okay, so with that being said, thank you guys for joining into the webinar, and I'll see you guys next time.